Hello and welcome to another in the video series providing an overview of the production module in SAP Business One. In this session, we will cover standard cost accounting. First, what is cost accounting? Basically, cost accounting is a way to record, classify, analyze, summarize, and evaluate courses of action strictly for the control of costs. It's basically a way to advise management on appropriate courses of action and to give them detailed cost information so that they can control the current operations and plan for the future. Whereas financial accounting aims at finding out the results of the accounting year and creates profit and loss statements and balance sheets, cost accounting aims at computing the cost of production or service in a scientific manner and facilitates cost control and reduction. Whereas financial accounting reports results and position of the business to outsiders, basically government, creditor, investors, etc., cost accounting is an internal reporting system for the organization's own management use. When it comes to production, cost accounting takes on the guise of standard cost accounting. Basically, standard cost accounting compares the labor and the materials that were actually used in the production of a good with those that the same goods would have required under standard conditions or ideal conditions. It does that through the use of two things. First, historical costs. Historical costs are costs that have been incurred in the past for items such as components or labor or resources or overhead. It provides the basis whereby materials and labor may be valued in the future based on past experiences. And probably more important than the historical costs themselves is the variance analysis, which basically looks at the variation between the actual cost to produce a good and the standard cost so that managers can understand why the costs were different from what was planned and therefore take the correct appropriate action to correct the situation. So what does that mean in Business One? Let's take a look at how you would use standard cost accounting in the production module of Business One. Here we have our finished good item 200, FG200. And it is a parent item. There's a bill of material for it. The way to use standard costing accounting in production is to change the valuation method that is used to be standard. In our previous examples, all of our finished goods were set to be moving average. Here we have set FG200 to use a standard valuation method. And we have set that standard cost by warehouse to be $730. Our cost accountants have determined that the components required to produce FG200 should cost $730, and so that should be the evaluated cost of the item when it is received into inventory at the end of a production run. So let's see that in action. First, we will create a production order using FG200. We'll add it and release it. And for the purposes of this exercise, we will just go straight to reporting completion. Yes, 175, finished good 200 will be marked complete, quantity of 1. We will go ahead and add it. Let's come back and take a look at what journal entry was created. We'll see that the finished good inventory was increased by our standard cost of $730, and our WIP inventory was reduced by $730. Let's take a quick look back at our production order, and now let's take a look at the summary tab. On the summary tab, we see that we had actual item components of $679 that were used. We had additional costs, in this case that was labor, of $65, and our actual product cost was $730. The $679 plus the $65 is $744, which meant we had a production variance unfavorable of $14. That is currently reflected in our books. We had the $730 journal entry that was made to record the receipt of the good, but as part of the receipt from production, $744 were put into inventory work in progress. As a result of these two journal entries, we are left with a $14 balance in the inventory work in progress account. How do we resolve that? Moving back to our production order, you recall that the last step in the production order process is to move it from released to a closed situation or status. We will update it. Moving back to our journal entry window, moving to the last journal entry that was made, we see that the inventory work in progress was relieved of that remaining $14, and the journal entry was debited, because it's unfavorable, to a WIP material variance account that is set in the GL account determination. By evaluating the activity in the WIP material variances account, the staff accountants, the cost accountants, can evaluate which processes are out of control and need to be reviewed, either from a process standpoint or from a valuation standpoint, meaning perhaps the standard costs on the finished goods inventory need to be adjusted due to variations and fluctuations in the historical cost pattern. That concludes this video on standard cost accounting in the production module of SAP Business One. We hope that you found it useful, and we hope that you watch the other videos in this series on an overview of the production module in SAP Business One. Thank you.